Should I already share the slides, or are you going to say a few words at the beginning?
I will say just
Hi.
a very hi, first of all. No, I will say very few words, but you can already share your slides if you like.
One question. My name is Adriana. I can't open the camera. I'm going to present with Galina.
Okay.
I think you stopped it now. Then I can open the video.
So, but who is presenting them then? Of you two?
Adriana is going to say a few words at the beginning, and then I'm going to proceed with the empirical part.
Yeah, sounds also good. Okay, perfect. So I just see that we are complete from the presenter side. Let me just say, so we have a 15 minutes presentation, 5 minutes for the discussant, and then again 5 minutes for general questions. Well, we have 3 papers, one on trade effects of the loi de vigilance, one of trade effects of SARS and MERS, and one of resilience in related to COVID. So please, Galina, the floor is yours for the first presentation.
Thank you very much. Thank you for putting our paper on the program. It is a joint work by Adriana Nelligan and me, and Adriana is going to say a few words at the beginning about the framework, about the challenges that are associated with the introduction of law like the loi de vigilance, and then I'm going to proceed with the empirical part. So Adriana, the floor is yours.
Thank you. Unfortunately, I can't start the camera because you as a host have turned it off, but I'll start anyway, not to lose any time. So Galina and I have worked on a paper which is a first attempt to evaluate the trade effects of a supply chain regulation by using data on French trade. So Galina, if you can switch to the next slide. I don't want to lose too much time in introducing. So our presentation is structured as follows. I'm first going to talk about the motivation and theoretical considerations of this paper. And Galina is going to take over then to explain the empirical analysis by explaining the data and methodology and the results. And finally, we're going to offer a summary of our results. So what is the underlying motivation and the underlying theoretical consideration on this paper? So the discussion on responsibility in global supply chains and the associated due diligence obligation have gained a significant momentum in recent years. So until recently, voluntary measures were predominant for multinational firms. Now, regulative national solutions have been introduced in several countries. So I'm just going to switch on the camera now. So thank you very much. Among other countries, France has already implemented a comprehensive due diligence law in 2017, which is called Loi de Vigilance. And Germany just recently, just this year, agreed on a supply chain law, the so-called Lieferkettengesetz. At the same time, at EU level, there's also EU due diligence regulation being discussed to introduce a binding EU due diligence regulation. And a proposal is expected to be presented at the beginning of next year. That was just announced today. So what is the theoretical motivation for such a regulation? It can help to internalize negative externalities along the value chain of production. So numerous German economists supported the German initiative for such a law by arguing on this basis, because the objective of due diligence regulation is the introduction of measures to itself and direct suppliers. Only in suspicion cases, indirect supply must be checked in the German case. So that's basically, we want to increase the sustainability of corporate supply chains by internalizing these external effects. With such targeted measures, it can reduce the incentives for local companies to exploit regulatory loopholes to the detriment of environment and workers in third countries. However, it can also have negative effects, especially concerning the engagement of companies in these countries, because, for example, EU companies or German companies or French companies, their local investments in third countries and their demand for preliminary products can create jobs. So if we look at the data, next slide, please. The international division of labor can bring considerable advantages for all countries involved. We've looked at OECD statistics on trade and value added, and what we can see is that final demand and exports of EU countries generate a total value added worth $970 billion in the listed non-OECD, OECD emerging economies, as well as for Mexico and Turkey. The graph shows that in Tunisia, almost 17% of the value added is generated by EU demand and exports. In Kazakhstan, it is more than 50%. In Morocco, it's almost 13%. So just keep in mind, the data presented here only capture the value added generated by the final demand of the EU. Overall, the EU counts for an important part of the value added of the countries concerned. However, and that's why I've also plotted the Corruption Perception Index, CPI, developed by Transparency International. These countries very often have a very weak governance, are less concerned with sustainability aspects, both in terms of ecological as well as social and economic dimensions. So in countries such as Kazakhstan, Morocco, and Russia, where more than 1/10 of domestic value added finds its end use in the EU and its exports, the problem of corruption is even more widespread. So Galina, you can introduce now the empirical part, please.
Yes, thank you very much, Adriana, for these introducing words and the overview of this data. So this is why we decided to conduct an empirical analysis on the trade effects of the introduction of a due diligence regulation by taking as an example the introduction of the loi de vigilance in France. We use as a methodology gravity equation, standard gravity equation model for the bilateral trade between France and its trading partners. So it is a partial gravity equation only for France, because it is the only country where such a regulation was introduced. And this is why we decided to use France. And still we have about 10,000 observations. The data is the standard data taken by CEPII as referenced by these references here, and it covers the time span between 1948 and 2019. We stop in 2019 in order to exclude crisis-related effects. And we use the standard gravity variables like GDP in the country of origin of the trade flows and in the country where they are flowing to, distance between the countries, common language, common border, colonial relationship, trade agreements, just the standard gravity variables that can explain trade relationships between economies. As a basic equation or a baseline, we use the standard gravity equation as represented here, and then we evaluate, or we search for the effect of the loi de vigilance by introducing a dummy variable for the years 2017, 18 and 19. So starting in 2017, the dummy variable has the value of 1 and 0 otherwise. And if the loi de vigilance was associated, or the years 2017 until 2019 were associated with significantly lower trade flows between France and its trading partners, then the coefficient of the variable here, the beta 8, would be negative. Of course, this is not a causality, it is just a correlation if we observe such an effect, but still it would indicate that in these years the trade flows were significantly lower, because if we take a look at the data, then we see that the trade flows have actually increased, but the question is it because of the standard gravity equation variables, or is there something else? So this is what we test by using this dummy variable. And in the next step, only one of them, because we want to stick to our time. we use an interaction term between this dummy variable for the years 2017 until 2019 and a GDP per capita variable. All the variables for GDP and GDP per capita are in logarithms. And by introducing this interaction term, we want to prove the hypothesis if the potentially negative effect of the law de vigilance was higher or lower for countries with a higher or lower GDP per capita or stage of development, because we expect that, with higher GDP per capita, governance and working conditions, human rights per capita. And here I'm going to present only part of our results because of the time constraint. So we have first our baseline equation in the first column, and we have the expected signs of the coefficients as in the standard gravity equation. Then we introduce in the second column, we introduce this dummy variable, and we have a significantly negative coefficient of the variable, of the dummy variable for the years 2017 until 2019. I have to stress that we use, of course, as it is usual in the literature, fixed effects both for countries, for time, for all the usual things that the gravity equation uses. So we have here an additional negative effect for these 3 years since the introduction of the law de vigilance. Of course, it is a very short time span, and still we can observe this negative coefficient. And then we introduce in the next column, in the third column, we introduce this interaction term between GDP per capita, and of course we introduce also GDP per capita in order to introduce the interaction term. And we have the interaction term between GDP per capita and the dummy variable. We still have the negative coefficient here, and what we observe is that we have a positive coefficient of the interaction term, which indicates that this negative coefficient, the negative impact on trade in the years 2017 until 2019 is even lower for countries with lower GDP per capita, or the coefficient gets less negative, or can also get positive for countries with higher GDP per capita. So if we put different values of GDP per capita into this interaction term and combine the values with the coefficient of the dummy variable, then we see that the coefficient is as high as minus 0.68 for a country with a GDP per capita of $2,000 US, minus 0.31 for a country with GDP per capita of 20,000, and just minus 0.20 for a country with GDP per capita of 40,000 US dollars. So the negative coefficient gets smaller in absolute terms. And as a robustness check, we have introduced in an interaction term with the variable colony, because the most of the colonies are countries with lower GDP per capita and with less strong governance compared to other countries, and we observe the same effect also here. And we have also other robustness checks using other data, because we have in the data sets both the direction of trade statistics by the IMF and also the Comtrade database by the UN. So we use both data sets to prove the hypothesis. So what we can conclude from our analysis is, of course, that we cannot find any causality, but still the introduction of the loi de vigilance was associated at least with lower values of international trade between France and its trading partners, and especially in countries with lower level of GDP per capita. We have calculated also a threshold value of around 13,000 US dollars in the second data set. This is the case, and especially in earlier French colonies. So we interpret the supply chain due diligence as some kind of a non-tariff trade barrier that does not only have positive effects, the effects that we want actually to achieve by introducing such a due diligence regulation, but it can also have a negative effect because some enterprises and companies stop purchasing their products from those countries because of the high costs of compliance. So the EU due diligence would still be preferable to national regulations because a non-tariff trade barrier, which is introduced by the different member states of the European Union, would also mean distortions for the internal market. But still we have to watch out that this regulation that is expected to be proposed by the European Commission does not remove the positive effects coming from the engagement of European companies in developing and emerging economies. So what could be the solution? What is the economic policy implication of our analysis? The solution would be, from our point of view, to try to develop a supply chain regulation which internalizes negative externalities without trade distortion effects. And as a basis, we can use, for example, the section 2007 of the US Tariff Act from the year 1930. Of course, it has to be developed further, but this section is constructed in a way that imports of goods produced with child and forced labor are prohibited in the United States, but not all the companies have to bear the compliance costs. The US administration has to prove every case that was declared or that was indicated, but only from case to case the costs are higher. So this can be actually a solution that can be developed further in order to internalize the potential negative effects without removing the positive effects coming from the engagement of European companies. So I'll stop here. Thank you very much for the attention, and I'm very much looking forward to hear your comments.
Yeah, thanks a lot, Galina and Adriana. We already have a few questions in the chat on the econometrics, but let's hear first from Benar or Nadine as discussants. Perhaps you can unshare your screen in case Benar wants to share his screen.
Okay.
Good morning and good afternoon, everyone. I'm Bernard Kirui. I'm discussing this paper on trade effects of supply chain regulation, empirical evidence from law vigilance. Thank you, Tiana and Galina, for the presentation. I really enjoyed it. These are very topical and highly relevant research. It features interesting discussion as there are plans of other countries to implement similar rules. I went through your paper and I have some recommendations for the introduction and the other parts. The first one is you need to expand on how government regulations differ from self-imposed policies by MNEs. There are self-imposed regulations like fair trade. I think you should also consider that. And there is also need to bring in the literature on fair trade in your paper, because I think I didn't see it, and it's one of the voluntary program by companies to implement or to reduce human rights violation and other negative effect of the activities in the society. On the empirical strategy, the estimated gravity equation, is it looking at the intensive or the extensive margin of trade? I think you need to come out clearly on this. I'll share these notes with you because there are a number of them. In your study, the policy variables, you are capturing it using a time timing, which is indicating the years after its introduction, that's 2017 to 2019. But in your study, you indicated that majority of the farms, that is about 265 farms, obligated to comply with the requirements. Around a quarter of these farms are not complied effectively with the law. So I think introduction of a dummy will require 100% compliance, unless maybe you consider this introducing this the dummy variable in the year full compliance was attained at the country level for each of the France trading partners, rather than at the global level, because what you did now, you did at global level, meaning that all farms complied are fully complied by 2017. But in your discussion, you actually mentioned that a quarter of these farms are not complied by 2017. Also, you can also consider a model that allows for phased compliance. I think there are some difference in different model, and I know also gravity model is a difference in difference. So you might need to look at literature. You might get some ideas on how you can allow for phased compliance. The other suggestion is using variation in exposure policy across products. If you can get data at sector level, I think that will also be useful, because you might realize farms in certain sectors complied, fully complied at a certain point, and other farms there was a delays or they complied in different times. So I think that's also an interesting way to pursue. The other comment is on the results on the effect of corporate due diligence law, which will show that is stronger for countries with lower per capita levels, trading with France. And I think this points to two things. That is, there is a heterogeneity in your results. So I don't, you might need to account for that. And also there is possibility, there is possibility of farms in different countries having different capacities in meeting due diligence requirements, especially maybe those farms that are trading with the French companies. So if you can have, I think there are some data which has been published on quality of, for example, regulatory quality, which you can get it in, World Bank usually publish worldwide governance data indicators. So you can actually look at that, because it has regulatory quality, which might capture the capacity for companies to meet those requirements, because I think that capacity can be built by alongside the regulatory capacity of the regulators. And the last one is you might need to consider falsification tests, because you mentioned that empirical evidence has already shown that traditional economic relations between African countries and countries such as Germany and US, or Western countries generally, have been changing due to increasing presence of China in the regions in Africa. So could it be that your findings are due to displacement effects of Chinese investors in low-income countries? So you might need to do falsification tests, and a good proxy might be to look at for this displacement will be to look at to use a 1-year lag of trade volume between China and each of the France trading partners. So those are my comments. I've highlighted what I've just mentioned in yellow, but there are some which I have not mentioned. So I'll share with you the comments. Thank you.
Yeah,
Great, thank you very much. Thank you very much for this very good development. Sorry, I'm a little bit sick, but still try to attend today. Thank you for those comments. They are really great. I would be we will be very grateful if you can send them to us. I have already written down a few of them, and probably just a few words about questions in the chat, and also questions that you raised. If we are testing the intensive or the extensive margin, well, it is an overall trade data, so it is both of them in a way. Which companies it covers, again, macro trade data, the trade flows, the bilateral trade flows, not on a sectoral level. This is also something that is asked in the chat. So this could be the next step. There is, of course, much that can be done further. We are also thinking about a difference in difference approach as a further development of the model. Well, I'm a big friend of as simple as possible, as complex as necessary. So we try to make the paper or to develop the paper in a way that it can reach the broad public. So this is why we try to stick to the simplicity of the model. But these are very good points, and probably just one word to the question about the coefficient of the colony variable. I think that the coefficient changes because of the introduction of the GDP per capita variable, because of a multi-collinearity or a high collinearity between the variables.
Yeah, thanks. There was another question about the fixed effects. Also, to me, it was not entirely clear, but in this short presentation, maybe, you know, which fixed effects absorb which kind of country, time invariant, or perhaps country characteristics. Like, I'm not exactly sure what you had all in your regression, but perhaps there's something to look at. But let's take one very quick question by Annie Wood. You don't need to reply to it, but just for food for thought, and then we can move to his presentation directly.
Yeah, thanks, Stefan. So just sort of adding to what you just said about fixed effects, I think one way to mitigate endogeneity related concerns, Galina, would be to try and use data on intranational trade flows. So, you know, right now you have data on cross-border trade flows, but, you know, consistent with recent advancements in estimating gravity models, if you included data on intranational trade flows in your data set, then you'll be able to properly account for some of these endogeneity related issues.
Okay, thank you very much.
Perfect. Well, Annie Wood, you can just go ahead with your presentation then. Thanks.
Excellent. Thank you so much. Let me just share my screen. Just give me a minute. Can you see my slides?
Yes.
Yeah, excellent, great. So let me just maximize this. Okay, great. So I'd like to thank the conference organizers for having me on the program. It was really late in the day, so I really appreciate accommodating me. This is joint work with Prachi Agarwal, who was earlier with the Center for Policy Research in Delhi, and now she's moved to the ODI in London. My name is Anirudh Shingal. I am an associate professor in economics at SPJMR in Mumbai and a senior program associate at the EUI in Florence. So quickly, you know, we have 15 minutes, so let me run through the presentation. Bit of a background. So as we all know, COVID-19, apart from several macroeconomic and health implications, it's also had significant effects on trade and investment due to disruption of GVCs. Recent literature has tried to identify 3 channels by which this has happened. So there's the demand shock caused by lockdowns and stalled economic activity. There's the supply shock, which emanates from temporary and permanent disruption in supply networks. And of course, there is the contagion effect. The GVC contagion effect emanating from multiple locations being affected simultaneously, and the high level of interconnectedness of the global economy, amplifying the effect. Now, these disruptions have reignited the discussion on geographical supply diversification, nearshoring, and repatriation of value chains. However, it may be both too soon and premature to examine the extent, nature, and exact impact of these disruptions using data currently available. We thus aim to inform the discussion by studying GVC responses to 2 past health epidemics, SARS and MERS, both to understand how value chains may have responded to those crises and also to draw implications of any and if at all for the current outbreak. Now, there are a couple of reasons why we choose to focus on SARS and MERS. Both outbreaks originated at an epicenter but spread around quickly. The diseases are characterized by flu-like symptoms, much like COVID-19, and manufacturing value chains are also disrupted by both episodes. Now, the other reason we look at both SARS and MERS is that These two health crises are separated by a decade in point of time. And during these time periods, the share of GVC trade in total trade was on the upswing and on the downswing in these different time periods. So that also makes it interesting to examine what the effects of these outbreaks were on GVC trade. So how do we contribute? We contribute to the literature by studying GVC responses to these epidemics observed in actual trade data. And then we explore the following hypotheses. The disease outbreaks were associated with a rise in domestic production at the expense of total imports. This is the reshoring hypothesis. There was a tendency to reduce the share of imports from disease epicenters. This is the geographical diversification of value chains hypothesis. The disease outbreaks were associated with a rise in the number of suppliers for each GVC-based product that was imported. This is the GVC widening hypothesis. There was a tendency to import more from suppliers in the geographical neighborhood at the expense of the disease epicenters. This is the nearshoring hypothesis. And finally, GVC disruptions coincided with the time period of the virus outbreaks, but dissipated over time. This is the GVC resilience hypothesis. So we systematically examine each of these hypotheses, first by eyeballing the actual trade data, and then using some more sophisticated empirical analysis embedded in the structural gravity framework. So what do we do? So we use different analysis to examine the effects of the supply and demand shocks induced by these disease episodes on bilateral trade in GVC-based products, as well as value-added trade in a gravity setting. We measure the shocks using binary dummy variables that take the value 1 for the SARS worst affected countries, and there were 5 of them: China, Hong Kong, China, Canada, Singapore, and Vietnam in 2003. And 3 countries that were the worst affected by MERS. These were Saudi Arabia, South Korea, and the UAE. And for the MERS worst affected countries, the treatment timing varies. So Saudi Arabia was the worst hit during over 2013 to 2017. South Korea had severe episodes in 2015, and Saudi Arabia and the UAE was the worst affected in 2014. So you see that in the case of MERS, the treatment timing varies. And in a nutshell, therefore, our identification strategy exploits differences in the time period of severe incidence of each disease and in the samples covering both exporting and importing countries that were more adversely affected than others. And these are kind of reflecting the respective supply and demand shocks. So, just to summarize the main findings from this work, the adverse effects of SARS on both intermediate and final GVC goods exports were observed with a 2 to 3 year lag after the official end of the SARS outbreak in 2003 at the extensive and intensive margin respectively. Interestingly, similar adverse effects at the intensive margin were not observed in the case of the MERS outbreak. At the same time, there is some evidence for geographical diversification of value chains. The MERS-induced supply shock was accompanied by a rise in the number of trading partners for GVC-based intermediate products and by a decline in partner concentration for GVC-based final goods. There is also some evidence for reshoring and nearshoring in the stylized facts. So when we eyeball the actual data. The value chains also seem to have been non-resilient to the SARS outbreak. So the adverse effects at both margins were accentuated significantly over time. The findings are observed at both the intensive and the extensive margins, and they are also robust using different data sets and alternative estimation strategies. When we tried to explore the drivers of these effects, we found that the SARS effects were driven by non-OECD countries that were also more integrated and downstream in GVCs, and by products that were less capital and technology intensive. Thus, GVC participation was an important mechanism for propagating the SARS-induced shocks. We could not do too much of the analysis on MERS because the MERS outbreak still has continued sporadically in Saudi Arabia past 2018, 2019, and we would need more recent data to be able to examine and analyze those effects. So, the paper is related to different strands of the existing literature. There is the macro consequences of natural disasters. There is a literature on the robustness and resilience of supply chains to global shocks. There's a lot of literature now looking at the role of GVCs in the propagation of the COVID-19 induced shock. And then, of course, there is literature that looks at the determinants and effects of the global financial crisis and natural disasters, especially the 2011 earthquake in Japan. So the data are basically, the bilateral trade data come from Bachi. The data are fairly disaggregated at the 6-digit level, and they have been classified as intermediate and final products in GVCs according to the World Bank WITS classification. In complementary analysis, we look at trade and value-added data using the Untitled GVC database. And the reshoring analysis is carried out at a different level using the UNIDO's INSTAT database. And for this purpose, the HS6 data were aggregated to the ISIC 4-digit level. So I'm going to quickly take you through these graphs. So, was there reshoring? So there is, the left graphs show intermediate products, the right graphs show final products. And these are basically, the top panel shows imports, the bottom panel shows domestic output. The two bands, the narrow band refers to the SARS episode in 2003. The wider band refers to the MERS episode from and focusing on 2014 and 15. And you see that there is very little evidence to suggest that imports declined during these episodes and domestic production went up. If you look at geographical diversification next due to SARS, we look at so the top panel looks at main shares of intermediate imports, the values, and the next two look at different measures of extensive margin, the mean number of intermediate products, and the mean number of partners. And you can see that in the case of China, there is no, the data itself doesn't suggest that there was any downswing. But if you look at Hong Kong, there seems to be some evidence for a negative effect of SARS at the intensive margin in the top panel for some sectors. And similarly, if you look at Singapore, again, there is some evidence for an intensive margin effect of SARS for some sectors in the top panel. Similarly, you see some effects in the bottommost panel for both Hong Kong and Singapore. Similarly, if you look at MERS, so did countries actually import less from Saudi Arabia, the UAE, or South Korea during these episodes? Again, you will see that there is some suggestive evidence indicating that there might have been lower reliance on these countries as sources of imports. And this is much more, this is far more observed in the case of Saudi Arabia, and especially at the intensive margin. But also, if you look at South Korea in the bottommost chart here, you see that the number of partners has gone down for South Korea. Now, to examine these trends, empirically, this is the intensive and extensive margin analysis deployed. So the first thing we do is we combine the supply side and the demand side shocks into one variable, which takes the value 1 if either the exporting country or the importing country was amongst the worst affected countries and coincides with the time period of severe incidents. And the reason we do that is that we kind of hypothesize that in a global general equilibrium framework with integrated value chains, the distinction between demand side and supply side shock becomes nebulous. So it's interesting to just capture them using one variable. It also makes identification easier because we can then deploy the full battery of fixed effects, and which are no longer collinear with the supply side and the demand side variables. So the primary intensive margin equations are 1 and 2. So this is the log of exports from I to J at time t, either in intermediate products or final products. This is the SARS variable. This is the membership of trade agreement variable. And this is the exporter time, importer time, and the dyadic fixed effects. So we have equation 1 for SARS, the similar equation, the analogous equation is for MERS, equation 2. And then that's the extensive margin, the intensive margin. The extensive margin equations 3 and 4, they look at the number of products that were exported from I to J at time t. Again, both intermediates and final. The control variables remain the same. For the geographical diversification of value chain analysis, we look at 2 different outcome variables. One is the Hirschman-Herfindahl index, which is again computed separately for intermediate and final products. So this is from the exporter in product P at time t. Now we depart from the gravity framework in this case, and the major control variable therefore is the SARS, the SARS shock in the exporting country and the MERS shock in the exporting country. This is what the outcome equations 5 and 6 are, and the fixed effects are product time and exporter product varying fixed effects. The other outcome variables in 7 and again, for both intermediate and final products. And so the number of partners that each exporting country had at time T. Again, the control variables remain the same. Okay, so quickly going on to the results. So this is the intensive and extensive margin analysis, the result for SARS OLS estimates. And you can see, this. So if you look at the gray highlighted portions, the top panel is the intensive margin, the dependent variable is the log of exports. The bottom panel is the extensive margin, the dependent variable is the log of the number of products exported at the HX digit level. So you see that the coefficient on SARS is negative in 2001-7 and 2001-8 for intermediate products, and then weakly significant for final products in 2001-6 and strongly significant in 2001-7 and 2001-8. So clearly there is, there is evidence to suggest that, SARS had an adverse effect on trade in both intermediate and final products, though these adverse effects were only observed after a lag. So, the SARS epidemic officially ended in 2003. There was a lag, but the other interesting thing is that you see these adverse effects getting accentuated over time, which seems to suggest that the associated value chains were not resilient to this disease outbreak. In the bottom panel, you see similar effects at the extensive margin for final products, even very close after the end of the official end of the SARS outbreak. And again, the effects get accentuated over time. But even for intermediate products, you see more pronounced effects as you go further into time, once again suggesting that the associated value chains were non-resilient. Geographical.
So we have about 1.5 minutes left.
Okay, I'll just rush through this. Geographical diversification, again, as I said, so there is, the HHI seems to go up with SARS. SARS has a positive effect on the HHI, which basically seems to suggest that there was evidence more of concentration of products, of traded products. In the case of MERS, you see that the coefficient is negative, suggesting that there was actually more diversification. Now, I've already talked about these, but these are the aggregate drivers. So high income countries are more likely to manage crisis better. In a world of complex interconnected supply chains, the heterogeneous impact is likely to be conditional upon the degree of production linkages. And then, of course, trade costs get compounded by shocks, and all hypotheses were confirmed by the aggregate analysis of drivers of SARS. Finally, just before we end, I just wanted to quickly throw in a comparison between SARS and COVID to put things in perspective. And it makes, it's tempting to make these comparisons. But, the overall impact of COVID is likely to be much worse because, of course, the scale of the current pandemic is much larger. And then, the state mandated social distancing norms, etc., have been more severe. And the other thing that has been impacted more severely this time around is services trade. The other thing to understand now is that China is also different. In 2003, accounted for only 4% of global output. Today, that number has quadrupled. But then the kind of products that China specializes in now is also vastly different. So at the same time, there is already anecdotal evidence suggesting that countries may be reducing their reliance on China. And there is some evidence suggesting that countries are looking at China plus one partners or different countries in their geographical neighborhood. So it would therefore be interesting to study these changes and their ramifications on GVCs in future research on this subject. Thank you very much.
Yeah, thanks a lot. Let's move directly to Galina and Adriana's comments.
Thank you very much. I will just make a few short comments. I like the paper very much. I enjoyed it very much. It is a very comprehensive analysis, and it is, of course, very relevant to our current situation. What I can probably, or where I see a potential to improve it is probably you can try to shorten a little bit or to formulate more concise more concisely the both at the beginning the hypothesis and also during the whole paper. And my question would be because I suggest, or let's say, I suppose that it could be a little bit difficult to bring it to a journal in this length. And I think that there are, at least in the first part of the paper, there are a few text parts that can be, or where there is a little bit well, the potential to shorten them a little bit. I would say it like this. And my question would be, what would or what are the economic policy implications? How should policymakers respond to these results, and how can they support firms, or should they support firms? These are well, questions that arise in my mind reading your paper.
May I just add one thing? I think what is great that the paper addresses at the start hypothesis on 5 aspects. It's on reshoring, diversification, GVC widening, etc. And I think during the paper, it would be nice to find them more concise. I think that would help the paper if it was picked up more clearly in the conclusions. Like in the empirical part, I can find it. I tried to go through, and I think if the conclusions were kind of put, like, go back to what we started off with, maybe that's also a good help to shorten the paper if we kind of concentrate on the hypothesis. Otherwise, I think the paper looks great, and from a methodological part, you've checked for different parts of robustness and you follow these hypotheses. The question is if one or the other kind of graph could be taken out to be only described verbally to make it shorter for a paper. Well, thank you very much.
Thank you. Thank you so much.
Yeah, perhaps you would like to reply to some of those comments. And in the meantime, if anyone from the audience has a question or remark, please raise your hand or write in the chat. There's one question, but perhaps you can briefly
yeah, so thank you so much for those comments, Galina and Adriana. They're well taken. I realize that the paper is seems to be a tad too long, and it makes sense to probably shorten the analysis here and there. And I like the idea of kind of re-emphasizing the extent to which the hypotheses have or have not been met in the analysis and the findings towards the conclusion, just to sort of wrap things up. I agree with you on that.
So there's one question in the chat that's essentially on how come you have chosen these time periods, like 1 to 2006, 1 to 2007, 1 to 2008. So why didn't you choose 6 to 8, I guess is the question, or 1 to 5, etc. Yeah.
So basically, since 2003 was the year which was the basic year of incidence of SARS. So the idea was to look at 2 years before that epidemic and then try and go up and see whether more pronounced effects were associated or were observed as you went further ahead in time after the SARS epidemic officially ended. So that was really the idea, because a lot of the different literature suggests that you should have 2 years before the treatment and then at least 1 year after the treatment.
Does it answer your question, Shanja? Well, if it does, I think then we can perfectly on time move on to the third presentation. And of course, if there are more questions coming in, please feel free to write them in the chat, and then Annie will see them and reply to them, I guess. But let's move to the presentation by Bernard then, which is this time a micro paper on resilience in Kenya related to COVID-19. Please.
Thank you. And first of all, I want to thank the facilitators for giving us this opportunity to present our paper in this conference and also benefit from the discussions. This is a joint paper together with Peter, Verena, and I. This is the outline of the paper. We start with motivation, then we discuss the context, and then followed by mapping the Kenyan production network and COVID-19 and key farm dynamics, then relevance of network position, and then we conclude the paper. Countries, sectors, and firms are connected through global national supply chains. The ongoing pandemic put a spotlight on the role of supply chain structures for farm dynamics. A large and growing literature documents how interdependencies plays a key role in the transmission and amplification of shocks. Kenya, like other countries, was adversely affected by the COVID-19 shock. This shock provides us with an interesting setting to empirically study farm network dynamics during a period of heightened uncertainty and a large aggregate shocks, and also to draw on up-to-date farm and transaction level data to look at the impact of ongoing pandemics on farm-to-farm relationship and farm outcomes in Kenya. Against this background, we asked the question, what role does the farm's ex-ante position in network play for its trajectory during a large aggregate shock, and also the role it plays on the recovery from a severe shock. To address this main question, we attempt to address 3 sub-questions. The first sub-question is, how does the structure of the Kenyan production network compares to other economies? And then the second sub-question is, what happened to key farm level outcomes and farm-to-farm relationship during the COVID-19 pandemic in Kenya? And how does the position in the farm network matter for farm resilience? We'll come to each of these questions and we'll look at actually what kind of answers we are getting from our analysis. So we look at the context and the data, and we study close to 57,500 farms, formal farms, with over 4.1 million inter-farm relationship in Kenya. That is for the period between January 2015 and March 2021. In 2019, the farms we studied had a value added corresponding to 30% of Kenya's gross domestic product, and accounted for farms exporting, and accounted for 4% of the farms exporting and 14% of the farms importing. The first case of COVID was reported in Kenya on 13th of March 2020, and this was followed by closure of schools, which happened immediately. And immediately after that, we are seeing the sudden drop in weekly transactions relative to 2019. That is shown by the red line is for 2020, the dotted line is 2019, and the green line is for 2021. This was followed by closure of borders and domestic travel restriction, which was implemented in April 2020. However, in mid-July 2020, travel restriction was lifted, and it was not until towards the end of September 2020 when hospitality industry fully reopened. We contribute to 3 strands of literature, that is production networks, impact of COVID-19, and farm heterogeneity. And our paper relates to the work on empirical patterns of production networks, and our contribution is mapping and comprehensively describing Kenya's production network. With regards to the literature on propagation of shocks in domestic production networks, we depart from the work in this area by studying economy-wide and aggregate shocks. And the last on production network is farm-to-farm relationship literature and on uncertainty. And here we our contribution is we added a domestic lens on literature with focus on international trade. The second strand of literature is on the impact of COVID-19 related shocks on farm dynamics, on trade and global value chains, and in a networked economy. And here our contribution is we added a focus on domestic trade, and we studied a broader range of farms in large variety of sectors. That's our addition to the literature. The last strand of literature we contributed to is the farm heterogeneity. And here we showed how ex-ante farms position matters for farm resilience during crisis and recovery. We now down to the data. We use tax administration data, and some of the variables, basic variables we have in our data include farm age and farm sector and headquarter location and also business type. In terms of monthly variables, we have the sales, purchases, imports, exports, and employment and payroll data. Network linkages we measured using number of buyers, suppliers, travel time to trade partners, characteristics of trade partners. Network was measured using a trade volume and number of transactions. We also supplemented this data using product country level customs data from UN Comtrade, and we deflated all nominal outcome variables using the monthly consumer price index. We turn now to the first research question, and in this research, to answer this research question, we look at the sales to farms within the network and outside the network, and also we compare the fundamental network characteristics to other contexts where data comparative statistics are available. And what we observe is that on the upstream side, what we see is that the median statistics are lower than the mean statistics across countries with comparative statistics. That is, we have Kenya, Costa Rica, Dominican Republic, and Belgium. And the reason for this is that this implies that few farms have larger numbers of suppliers. This is in the case of suppliers. We also see the same in the case of downstream, where we observe that that few farms also have large number of buyers. When also we compare with other countries, we see similar patterns between Belgium, Japan, Costa Rica, Dominican Republic, where we have larger farms having more suppliers and buyers, as shown by the positively sloping graph. Although I know the axis might be different, but they measure the same phenomena. So what we conclude here is large farms have more suppliers and buyers. We now turn to the second question: what happened to key farm level outcomes and farm-to-farm relationships during the COVID-19 pandemic? And here to address this question, we use event study design, regressing farm level outcome on a series of time dummies controlling for farm and monthly fixed effect. We also focus on sales, purchases, employment, and value added per worker as key outcome of interest. What you will notice in the graph is that the gray and the gray and the black, these two lines show circularly domestic purchases and domestic sales, which show drastic declines following the onset of COVID, and we don't see the same decline in international trade. So what we conclude is that the impact was high in domestic trade compared to international trade. So
so you have about 4.5 minutes left.
Okay. We also look at farms, how did farms responded, and what we see is in the graph to the left, we see sales decline and also employment decline. So farm responded by cutting employment, or by cutting jobs, or by laying off workers to smoothen value added. Here we see active farm-to-farm relationship drop by 20%. That is the yellow line, and also aggregate farm-to-farm trade drop by 22%. That is the black line. Which type of relationship became important? Here we split farms into new relationship, those between 1 to 24 months, and those above 24 months. And what we see is old and new formed farm-to-farm relationship gain importance relative to young ones. We look at also with regard to the research question number 3, we used event study, farm levels, and we measure ex-ante farm network using annual network observed in the same months of previous years. We did this for extensive margin and intensive margin. The extensive margin we measure by number of buyers and suppliers, with top quartile lying highly diversified. For intensive margin, we use Hevindal index, measuring concentration of sales, and 0 implying, it ranges from 0 to 1, and 0 implies strongly diversified, and 1 least diversified. What we observe is that in the case of extensive margin, it matters because we see the caps started opening up immediately after March, during after COVID hit, after the COVID shock. But for the number of suppliers to the left, and the graph on the right on the number of buyers. With regard to intensive margin, we didn't see this, and so intensive margin seems not to matter a lot. We also used shift share design, and this is the equation. And what we observed with regard to shift share design is that a variation in foreign demand shocks through export channel is negligible relative to domestic demand shocks. And also, secondly, the exposure to indirect shocks is smaller than direct shocks. And lastly, the exposure to indirect shocks at demand shocks is not limited to farms that are located very centrally in the farm-to-farm network. So in summary, what we see is that we see near universal drastic downs of farm sales and purchases with shift recovery. We see also that we find that recovery so far seems insufficient to make up for the lost growth potential. And we find also that farm-to-farm links were put on hold but recovered quickly. The fourth one is we find that extensive margin is particularly key, while intensive margin is not that particularly important. It is still a work in progress, and we are working on using extending analysis by using farm level analysis to better understand adjustment to farm relationship, and also expand analysis to diversification and supply chain complexity. And lastly, using shift share design to study adjustment to suppliers and buyers relationship, and also to study the relevance of network position on pass-through of shock. Thank you very much.
Yeah, thanks a lot for your presentation. Let's move directly to Anirudh. And of course, if you have questions, please post them in the chat. But let's hear first the comments.
So I have a few slides. So Stefan, if you can, if they can stop sharing the presentation. Yeah, thank you. Just 1 second. Just 1 second. Can you see these slides?
Yeah.
Okay, great. So yeah, So I think this is a very, very interesting paper. I really enjoyed reading the paper. It provides very comprehensive analysis. It explores the domestic aspect of interfirm linkages along with the role of GVCs, adding to a few other papers, recent papers that have started doing the same thing with respect to some other countries. And I think providing information on Kenya is definitely a valuable contribution to the literature. And then, of course, it contributes to several strands of the extant GVC firm COVID-19 literature. So all in all, a very favorable paper. I have a few remarks and, just sort of a few thoughts that the authors might want to take note of in the next iteration. So I was wondering if there is a potential sample bias, though I understand the challenges and the implications involved. But the value added of covered firms accounts for only 30% of Kenyan GDP. So I was wondering the extent to which we can generalize from the findings, or whether there is some way of addressing this. The other thing that occurred to me is if there is any other way to capture intra-EAC trade at the partner country level, because I think exploring regional value chains in the context of a negotiated trade agreement would add another interesting layer of analysis to an already very comprehensive paper. Then there's a question, are you sure that there is no monthly trade data in UN Comtrade for China, Vietnam, and South Africa? Because not having these countries in your measure of global demand is a non-trivial exclusion. And I think I've been looking at this data recently, and you might want to check. I think these data will be available. So you might just want to go back and see. And then, finally, one would expect more complex supply chains to be more badly hit during crisis episodes. But your analysis finds statistically weak evidence for this. So I was wondering, could the reason for this be actually very Kenya specific and instead illustrate learning from previous low growth episodes? So just a few sort of, thoughts to reflect upon. Thank you.
Yeah, thanks for your comments. Perhaps just to add on the very first point, I have a similar thought. I think it's very great that you have this paper now for Kenya, developing countries, not only for countries like Belgium or Japan, but I'm also wondering, because you only capture the formal sector, and in those other countries, of course, almost every firm is formal. But for Kenya, do you have any information whether these networks also expand into the informal sector, or are they really limited to the formal sector, to the firms that you're now observing? Perhaps you could briefly reply to those, give some replies to those comments, and then we can see as there are other questions coming in.
Thank you. The first question on 30% of the possibility of sample bias, since our sample covers 30% of the Kenya's GDP. The data we use, we draw so much from the value-added tax returns, and there's a threshold beyond which firms are required to register, and below which they are not required to register. So the threshold is about Kenya shillings 5 million, which is about should be about $50,000. So that means there is a lot of firms that small firms that are left out of our data because they don't file VAT, and this mainly covers firms in the informal sector and also formal firms that are small, not to get to the threshold. So I think that's why, and one of the characteristics of developing world is a very large informal sector. So Kenya is not unique, and I think it accounts for almost 70% of employment. So it's quite huge. So 30%, I think, is for formal families, value added is quite, yeah. The second one is capturing intra-trade EAC. EAC in that trade. So the challenge we had here is that about around 2017, the trade between East Africa trading partners to a single window. So that if you declare on one side of the of the border you don't declare on the other side. So transactions are captured and one-sided, and we had challenges in reconciling this number. So that's why we didn't include ESC country, the trade between ESC countries. I don't know, maybe my colleague want to say something, Verena.
Yeah, hello. Yeah, thanks a lot for the cool comments. I think I have a response to of supply chains. I think definitely there we're still working on having other types of measures rather than just counting the number of inputs and products. But I think what's also key to remember is, and what we see in the data, is that firms that have complex products and complex supply chains are inherently very different from the firms that don't. And it's a bit similar to kind of the international supply chain linkage story, where firms that are able to export and actually link to global supply chains are also those that are different in terms of size, in terms of their general resilience, in terms of the access to financial markets. So actually finding not that much of action there is actually not that implausible, because these firms are much better able to cope with these kinds of shocks relative sort of to the small firms that we're seeing. Yeah, on the comparison to GDP, I think Bernard has already mentioned a few key points. I think one thing to remember is also that a large proportion of Kenya's GDP is coming from the agricultural sector, which is dominated by smallholders, which you obviously are not tax paying. So, you know, actually I think 30% is actually a massive number that is captured in this data set. So I think probably more than we would have expected otherwise, given the large sort of prominence of agriculture for the economy.
Great. So there are two more questions, basically on the policy intervention. So during your time of observation, have there been any policy interventions that have helped those firms coping with the shocks? And well, how is this reflected in the analysis, or could it be? Would any of you shortly reply to that?
Okay, as I mentioned, this is still a work in progress. So we have not really shaped the policy application. As I indicated also that there is still some extension areas we would like to carry further analysis. So for now, I think we are still looking at drawing those policy implications once we farm and we carry out a thorough analysis of our work.
Yeah, okay. I mean, I think it was also meant as a food for thought or possible extension in the future. But I don't see any additional comments at this point. Of course, feel free to write them also now after the session into the chat. I think Verena and Benar will see them and take them on board. In the meantime, we are having a break now until 1 o'clock when the next session starts. For the presenters, we have also this wonder space where you can meet and discuss further. This room will also remain open, but other than that, I wish you a good lunch break, and I'll see you all at 1 o'clock again. Thanks.
Thank you.